just a reminder, if you have positions, weekly positions open next week, we have a very shortened trading week next week. Markets close early on Thursday, July 3rd. They close at 1 p.m. on Thursday, July 3rd, and the markets are closed on Friday, July 4th. So if you have any positions that are expiring next week, you want to close, roll, or adjust them probably before 12:30 Eastern Time on Thursday, July 3rd, in observance, of course, of Independence Day, 4th of July as well here in the U.S. All right? So just make sure you keep that in mind. With whatever setup you have, whatever options positions, I should say, that you have, you want to make your adjustments by about 12:30 on Thursday afternoon. All right, ladies and gentlemen, all that being said, we're going to navigate over now to our PowerOptions suite of tools. And of course, we're going to use those tools to help us go through any discussions that we have and any questions that do come in. And of course, as always, I encourage you to send in your questions. If you have any questions for today, go ahead and queue those up and send those to us in the question pod. Now, I had a gentleman, a coaching session, sort of it was Ernie's coaching session actually, but I had to do a follow-up on this discussion. I had a gentleman that was looking for deep out of the money bull put credit spreads, similar to what I do. He's going 1 or 2 weeks out in time. And he called and he talked to Ernie because he was concerned that his positions weren't being filled. He's using Schwab, and the positions that he saw on PowerOptions, he could never get fills. In fact, a couple of them, they told him that the positions were actually, the credit spreads were done at a debit, not a credit. It didn't make much sense to me until I took a look at what his criteria was. And I want to walk through that because I think it's an important lesson for everyone here. So essentially, let's just go to bull put credit spread, and I'm going to go to the search tool. It's probably going to pull up my preferred default, the weekly bull puts. And this is what I use, 14 days out in time, 11 to 14 days out in time, usually opening positions on Monday or Tuesday for 11 to 10 days to expiration, targeting around a 14.9% average return with about an 87% success rate. This is what I kind of look for on my personal criteria that I back tested and it works for me. I use it with about 15% of my personal portfolio. Now, the gentleman was going a little bit deeper. Let me clear some of these settings. What I noticed the gentleman was using is he was using the time frame of all expirations, but 0 to 15. Now, this might look a little bit different because we have already ended the trading day. But he was going 12% out of the money and looking for, I believe, a minimum net credit of 10 or 15 cents. I don't know if he had a minimum return. We'll get to that later. And just some basic things here. He didn't have anything for bid-ask spread. So on PowerOptions, on any spread positions, and on most single option trades, you can limit the bid-ask spreads. You're not seeing things that are biotechs or things that come up with a high return that have a very wide bid-ask spread. Now, he was using an option volume today greater than 0. He was using an open interest greater than 0. And the probability, he was only using 70%. Now, this is a theoretical probability. In the case of our bull put credit spread, the stock will stay above both strikes, the puts will expire worthless, and will keep the net credit. I prefer to use 85. But he's more focused on this 12% out of the money or more. Now, I don't know what other criteria he had. I'm using stocks above the SMA 20, a positive MACD crossover. I don't know if he had any other restrictions. He did have a volume restriction of, I think, at least 4 million, or 1 million, I think it was, per day on the stocks in the technicals and fundamentals. But let me just run this search real quick, see what we can find. Yeah, okay, so this is a perfect example. Now, here I do have the long option ask and the short option bid price available. He was looking for a specific position. It was on ENPH, Enphase, if I'm not mistaken. And he was seeing these types of returns, 120%, 270%, 110%. Net credit, let's take the first one on a line tech here. It's a 250 spread with getting $1.83 net credit. So if I get $1.83 net credit on a bull put credit spread, we're going to sell the 162.50. We're going to buy the 160. Let's just go ahead and go to the profit and loss chart real quick. And this would be our spread position. Well, With a total cost of 182.50, I'm sorry, total credit of 182.50, we're risking 68 cents on a 2.5 spread, 2.5 point spread for a 270% return. Now, these were the kind of things that he was seeing. And he was trying to place these trades as a broker. His trades that he was trying to place today were for today's expiration. He was trying to place them at about 10:30, 11 o'clock in the morning. He was looking at today's expiration. 12% out of the money, mind you. Now, these are 14 days out. But back on the search, you saw the problem. Let's take a look at our sell contract. This 162.50 has a midpoint of 225. And the 160 put has a midpoint of 43 cents. But when I go to view options for the full chain, I go to 14 days out in time. I see here that the bid is at 0 for our sold option and the ask is at 450. Now, there was some open interest on this position, but there wasn't any current option volume today. But this deep out of the money, on his end phase position, we saw that both options that he was looking at had option volume earlier in the morning. Right at the open, someone got filled at 43 cents. But his option that he was selling had this, it was 45 cents, I apologize, but had this same structure. 0 listed bid across the exchanges. 90-cent ask in his case for 45-cent midpoint. We can only post what the exchanges send us, what the data gives us. And by using the midpoint, of course, this is always my target that I use for my criteria. I entered my positions at midpoint. If it doesn't get filled in 10 minutes, 5 minutes or so, then I lower that down a little bit because I'm still trying to target that same 14% return. 14.9, 15, let's just call it 15. But this is where I was running into a problem. So the simple solution, when you're searching for deep out of the money options, whether you're looking for cash secured naked puts, you're running a search for out of the money covered calls with a very, very low probability of being assigned. You're looking for deep out of the money spreads in a 5, 7, 12-day time frame. In addition to looking for option volume today, so these positions here, that Align Tech option, the 162.5 put with the 0 bid and the 243 ask or whatever it was, simply put in an option bid of greater than 0. Minimum option bid, minimum option premium of greater than 0. Now, our search that we just created on the fly made some adjustments from our default search to show a similar thing. We have 42 results. By simply adding that option bid greater than 0, in addition, volume might have happened earlier today. There is open interest. Of course, you always want to increase those numbers, in my opinion. But let's go ahead and submit that search, see where we drop down to. 10. All right, so we cut the results down very significantly, and we've got better positions with better pricing, better opportunity to maybe get that. But as always, as I mentioned, it's a great idea, fantastic idea, to limit not only the numeric bid-ask spread, which is a little tougher, depending on what strategy you're doing. And if you're searching for stocks in the $400, $500 range for a spread position or something along those lines, the best thing to use is the bid-ask spread percentage. And our first guideline is I always want to use a 50% bid-ask spread. What does that mean? Well, as you hover over it here, it shows you, this shows the total monetary bid-ask spread expressed as a percent against the natural bid price. I'm not looking for anything that's 200 or 300% bid-ask spread difference from the actual bid. And we're going to do the same thing on the long as well, in this case, for a spread position. Now, I don't know if we're going to change a lot of those yet. We are. We're going to narrow it down again to 5 results. Applied Optoelectronics, AST Space Mobile. I've actually been looking at that one for a little bit. Nanonuclear technology. Robinhood is always an interesting one. Volatile, but fun to play. And of course, Coinbase we know is always volatile, but also fun to play with different positions. So we're in the wheelhouse, as I mentioned, of that 14, 15, 16% return. Probabilities, I lowered it down to 70 based on what the customer had mentioned, but I'd be at the 85 target, so I'd be looking at Robinhood, and Coinbase would appear on my specific search, potentially. those trades. Now they are the lower returns of those, but that's because they have the higher probability that I'm looking to gauge. So that's just another idea. You're looking for something with high volatility, for example. You're looking for something that shows a high return, spread position, even a cash secured naked put in some ranges to limit your bid-ask spread, put in a minimum option bid of 0 so you're not getting caught in that trap of a wide bid-ask spread. That's where the percent bid-ask spread comes in, and look for some option volume and some open interest. Narrow out those deep out of the money options that haven't traded in a while, and we can only display what is shown from the exchanges. So if that's coming up in the exchanges because it hasn't traded in 5 or 10 days and has a 0 bid, but someone put in an order at some point in the market, the exchanges, are holding that order, whether it was a buy or a sell of 120 or 140, it says, oh, you can get 70 cents for this option. No, you're going to get 5 cents, maybe 10 cents if you're lucky. It's not going to be 70 cents. So just keep that in mind. Better filtering, narrow down your universe of selections, be realistic on what your expectations are. And that's how you can do it. This. Looks like one of those biotechs, by the way, kind of one of those biotechs, but it's 50% return higher than all of the others. Yeah, it's got a 72% probability, but it's probably something that's more volatile as well. And of course, I could always add those columns in. All right. I just wanted to review that, just a basic concept. Always good idea to have good volume in your searches, good open interest in your searches, option bid as well greater than 0. Narrow down, filter out some of those things that haven't been traded in an extended period of time. All right. So moving on there, another thought that had come in, a thought that came in from Jim was, I'm doing covered calls. Does this still apply? Yes, I think it applies for all strategies. So let's take a look, Jim. We're going to go to the covered call search. And in my opinion, whether we're searching, Jim, for deep in the money covered calls with a high probability of being assigned and a higher downside protection, or you're looking to hold certain stocks longer term and you want to sell out of the money calls, or even if you want to sell at the money or just out of the money, looking for a little appreciation plus a little bit of protection, getting that income to work for you, I would suggest the same thing. Let me clear the filters out entirely. This is interesting, though. We've got a lot of things here. What kind of search are we doing? This is from May 16th. We were looking for high IV, a high IV ratio. So we're looking for higher return positions based on an IV-HV ratio. Not necessarily high volatility, but we're going 10% in the money. Well, the in the money options are always going to have usually a bid of greater than 0 because they're going to be close to intrinsic. But we put a minimum option bid price in of 85 cents. So we're already above that 0 line, Jim, that we were talking about. Good open interest, relatively good open interest, and some previous option volume, but not, excuse me, folks, not current option volume. We do have our bid-ask spread values. Let's take out the bid-ask spread values. And let's take out our minimum option bid price. And let's talk about this search that we created on the 16th. Previous option volume, relative open interest, 10% in the money, with a minimum 0.8% return if assigned. And we've got some stock filters here. Broker recommendations, stock above the 20-day moving average, positive MACD crossover, stock price between 9 and 250, no earnings between now and expiration. I might take that out for this little example, Jim. Let's go ahead and submit that. All right, now, so here are some things with some wide bid-ask spreads, not terrible. Yeah, $1.40 here, but could I get $5.30 on this position? Possibly. It's Neon, 22.83. Selling the 18th of July 20 strike call. Yeah, so it's 10% in the money. 23% downside protection, potential 14% return if assigned, with a 63% probability roughly of being assigned. Now, I'm not seeing anything with the zeros here, and that's fine. But, and I don't see anything that's out of bounds here with the the bid-ask spread percentage, Jim, because we're in the money. Let's flip the script. Instead of going 10% in the money, let's just go 8%, 7% out of the money. I'm going to start at 8% out of the money, Jim. Okay. Good bid. There's one. There's one right there. Perfect. Twist Bioscience. Stock's trading at 35.93. The July 50 call is showing a midpoint price of 245. Give you about a 7% downside protection and almost a 50% return if assigned. So net debit would be 33.48. And we're selling the 50 call. And if it's above that strike price, well, of course, then we'd make about $16. Well, it would make $16.52. Is this reasonable? How about this one? 10-cent bid on Land's End. 10.58 selling the 12.50 call. 10-cent bid, $1.25 ask. It's coming across from the exchanges. Could I get 68 cents for this? No. I'm getting 15 or 20 cents for this option. Am I getting 245 for our Twist Bioscience? No. We're probably getting 12 with higher volatility, maybe 15, maybe 20 cents for that 50 strike call. We're not getting 240. We're not giving ourselves downside protection on a biotech stock. Not good. We see this PBR, Brazil Petro, 50 cents. Am I getting 50 cents for the 18 call in the stock at 12.38? No, I'm getting 5 or 10 cents. 22 results that match this criteria. I put in the simple option bid price now, Jim, of greater than 0. What does that do to our results? We narrow it down to 19. Not terrible. And the bid-ask spreads aren't as terrible either. Here's, Zeta Holdings is probably volatile, but the 16.50 strike, 50 cent bid, 60 cent ask. Yeah, 55 is a reasonable target. 53, 52 here on VSAT. Reasonable target. Nothing out here looks too outlandish. This is the biggest one, I'd say. Life Sciences, another biotech. July 14 call on a $9.50 stock. 5 cent bid, 45 cent ask, 25 cent midpoint. I'm probably not getting that, to be honest, Jim. It's probably going to be 10 cents, 15 cents. And again, I could narrow that down further. Oh, sorry, folks. Using the bid-ask spread, I'm going to use that less than 50 rather than a hard number. I'm going to take that out. Yeah, so we take those out. We've got it down to 13. Celestica, high implied volatility. We see some biotechs in here as well, but that's due to the criteria that we put in. All right. Looking, 10% out of the money, 2% downside protection. That's going to be higher volatility. 10% in the money, minimum percent if assigned of 0.8%. That's going to be higher implied volatility. It's just the way the math works there as well.